Now let's look at a couple practice questions around finance leases and operating leases. At the outset of an operating lease, which of the following impacts to the balance sheet is true? Assets will decrease, liabilities will remain the same, shareholders' equity will decrease, liabilities will increase. Excuse me. So, as a review from our discussion on the finance leases and operating leases, remember that the impact on the balance sheet for both of them, the finance leases and operating leases, have very similar characteristics in how they're going to move the balance sheet. Specifically, the liabilities are going to go up for both of them, and that's due to the present value of the lease payments being reflected in the liabilities section. And usually if it's a 5 to 10 year lease, it's going to be a long-term liability specifically, although you may have some current portion of the lease reflected in current liabilities, but for the most part, overall liabilities will go up. So we know it cannot be B, and it looks likely that it's going to be D in this case. However, let's also explain the other side of the balance sheet, which is the fact that assets will also increase for both finance leases and operating leases because the right of use asset will also be included on the asset section of the balance sheet, and that will be a new asset that appears. So assets will also increase. So therefore it cannot be A, and it's not going to be C because shareholders' equity would actually result in no change. You'd have an increase in assets and a exact same increase in liabilities. So in this case, the answer would be D. Okay, let's look at the other question here. If the Good Times Roll Incorporated switches from an operating lease to a finance lease in the first half of the lease's life, what will be the impact on the income statement? Okay, so now we're going to see what happens when we switch from operating lease to finance lease. And one thing to kind of know right off the bat, remember the difference between operating leases versus finance leases is, and when it pertains to the income statement, is that on the finance lease, there's an interest expense component, whereas the operating lease does not have an interest expense component, just an amortization expense component. So what we know for sure is that there is a slight difference on the income statement, but how these typically tend to work through the curriculum of this exam is the assumption is that in the first half of the lease, the interest expense is going to be high enough that the interest expense plus the amortization expense of the finance lease is going to lead to a greater total expense added to the income statement than that of the amortization expense that alone is recognized for the operating lease expenses on a month-to-month basis. Therefore, we would expect the total expenses associated with a finance lease in the early years to be greater than that of the operating lease, which should lead to lower overall profitability. Now, the next question would be, where is this profitability going to be reflected? So if we actually start from the bottom up here, we'll take a look at gross margins, saying gross margins will decrease. Well, if we go from operating lease to finance lease, that is going to lead to less profitability, but it's not on the gross profit side. It's going to be further down the income statement. So that's not true. Now, when we talk about tax expenses, we'll actually put a pin in that one for a second, but EPS increasing and net income increasing, we know both of these actually cannot be true because, like we said, if we go from an operating lease to a finance lease in the in the first half of the lease or the early part of the lease, we're going to have total expenses being greater for the finance lease. So we'd actually expect net income and EPS to actually decrease, assuming all else equal. And if our profitability is decreasing, we would therefore expect the tax expense to decrease as well, because assuming the tax rate as a percentage stays the same, if you have 20% of a tax rate on a smaller number, given that the expenses are now larger, we would expect tax expense to decrease. So overall, this answer should be C.